Right, good afternoon all. Thank you very much for joining us for this Dura Capital Structured Products Update webinar. My name is Bo Bolgen. I'm the head of distribution team for Dura Capital, and today we're joined by one of our directors as well, Nick Johal. Quick disclaimer from me, and then we'll get into the webinar itself. So this call is for professional investors and eligible counterparties only. Any views expressed in this communication are those of the manager and are subject to change without notice. They are not necessarily the views of Dura Capital and do not constitute investment advice. Your capital is at risk. Past performance is not a guide to future performance. So got that little bit of admin out the way. Today we're going to kind of just, I think, rather than give a bit of big background to Dura Capital and all that, we're going to just jump into some points on structured products and a bit of a background to some of the products that we have out at the moment. Certainly as we head into the second half of the year, I guess we could say that the uncertainty continues. I know through June, I saw a commentator describe professional investors' views at least as all over the map. So a lot for investors, for advisors, for managers to think about at the moment on behalf of their clients. With this in mind, I think Nick is going to go and give us a refresher on solutions, really, problems and solutions that structured products can offer for your clients. I think that's pretty crucial at this point. We're then going to look at that a bit more specifically in terms of just structured products generally, but to give it some real world context as such, we'll just look at a Dura Capital plan, Plan 47. That really kind of helps illustrate a plan that we have out there at the moment. We're going to look at the payoffs and risks associated with those as well, with those plans, and we'll talk about those a bit more generally, and Nick will walk you through those. The key reason for one of those, and we kind of quite often focus on the payoffs and more the risks, and not just because of Nick's fixed income background, but I think it's pretty key, and Dura believe that the key to understanding structured products and being able to allocate to these products for your clients is to understand properly what those payoffs and what those risks are. So hopefully by the end of this sort of half hour, 35 minutes, we'll be able to walk away with a bit of a better understanding of that. So just before I hand over to Nick, if you do have any questions as we walk through the slides, hopefully you'll see there's a Q&A function on your Zoom toolbar. Just click on that, input your questions, and we'll set a bit of time at the end to cover those off for you. So Nick, brief introduction, but I'll hand straight over to you.
Thanks, Bo, and good afternoon, everyone. Thanks for dialing into the webinar today. Very exciting week for us at Dura. A few of us are back in the office this week, which is nicely coincided with my kids breaking up for the summer, and also managed even to get a haircut yesterday. So that's literally a weight off my shoulders. So today there'll be some slides, if you've dialed into these before, that are somewhat familiar. We're going to run through what structured products are, how advisors use and what sort of solutions they provide for client portfolios. And as Bo mentioned there, we'll take a look at our current Plan 47, which is a Credit Agricole auto call, defensive auto call. We'll look at that. And then we're going to change gear a little bit and have a look at why we're issuing dual index plans and the rationale for that, but also where the risk reward is, because we feel that actually you get paid very well for those dual index plans at the moment for a very small uptick in risk, and we'll run through some numbers to look at that. So we can flick to slide 2 there, please, Bo. So obvious place to start. What is a structured product? It's a generic term. It covers lots of things. It means lots of things to different people. But when we talk about structured products today, what we're talking about are bonds that are issued by big global financial institutions. They're linked to developed market equity indices, and they provide a defined risk, defined return payout profile. And today, again, we're going to focus on the auto-callable, or some people know them as kick-out plans, the same thing, structure. That's definitely still the most popular structure within the UK, not just within the UK, actually globally. both amongst retail and institutional investors. And one of the reasons is they provide an attractive yield with a defined return, defined risk characteristic, and a good amount of protection to the downside over the medium term. So if we can just flick to the next slide, please. So I'm gonna jump through these slides a little bit quicker than some of you may have seen in the past, just because you know, some of you will have seen them before, and I want to get onto and spend a bit of time on looking at those dual indices. So bear with me today. If there's any questions, do put them on the chat, and we can come back to slides. We'll leave 5-10 minutes at the end if anyone wants to go over things in more detail. So on slide 3, we're just looking at what sort of solutions do these type of investments provide to advisors. So the first thing is where do you generate returns? Now, when we did this webinar back in June, 6-year gilts had a positive yield, and they don't today. And in fact, yields on UK government bonds are below 0 out to 7 years. So we've gone from a lower and longer interest rate environment to potentially low forever. Yeah, and that's a direct result of the huge monetary and fiscal stimulus that's driven the extremely large debt piles that central banks have put in place as a response to this crisis. On top of that, we've seen dividends have been cut, and futures, and actually there's a market for future dividends. And if you look at that market today, it's implying dividend yields on the FTSE 100 in the region of 2.5% to 3% per annum. So significantly below the long-term 4% average that we've had on FTSE 100 stocks, but also much lower than the close to 5% we've seen more recently. Now, most of these investments, they offer typically around 6 to 10% per annum type returns, sometimes higher depending on the risk. You can look at lower risk ones as well, but there's pretty much a return profile for most risk attitudes. The second point on this slide is just how much, the fact that there is no alternative to equities in this type of low rate environment. You know, your typical balanced portfolios is well over 60% invested into equities currently. And what we suggest is that advisors think about using some of this portion of their equity allocation for an investment which gives an equity type return, but with a good buffer of protection to the downside. It's not risk-free. You do not get yields of 6 to 10% in this type of environment without taking some risk. But we think this is a good way to use up some of your equity risk budget. And we do recommend that they use as part of a diversified portfolio. Macro instability, I'm not going to say too much about this. There's plenty of commentary on it. Bo touched on some of it, and there's reams and reams, and probably not a lot I can add to the global macro environment, nor will I try to. But the idea here is that something which gives you a slightly more defensive equity option within the portfolio that can generate positive returns in flat and falling markets is probably about as attractive proposition as we've had for a long time, given the falls we saw this year. The last point on this slide I do want to spend a minute on is just to talk about the pension freedoms. So for us at Dura and across all of our businesses within the structured products market, you know, this has been the real largest tailwind. The majority of our inflows are coming from SIP and SIP portfolios. And it comes back to the idea that in this very low rate environment, which is likely to stay low for an extended period of time, you know, equities is the end game in town, but it can be very volatile, as we've seen. So if you think about sort of pension funds, they're typically looking for returns of around 5% per annum. And at one point, many years ago now, you could get that from UK gilts. You get it from high quality corporate bonds, but not anymore. And to achieve those type of yields, you need to look at more alternative asset classes. And I think this is where these type of investments fit quite cleanly. You know, there is no alternative to equities, as I said earlier, but they can deliver in any year plus or minus 20 or 30%. And that's not necessarily what we're looking for within these pension portfolios. These structured investments, they can act to cap the upside and build in a buffer protection to the downside and just increase that probability of returns of getting the type of return you need to have an asset that can match your liabilities over the medium term. And this can really help to manage that sequencing risk and then that idea of pound cost ravaging, which could impact portfolios, especially those that are currently in drawdown. If we could flick to the next slide, please, Bo. So coming back to this idea of defined returns for defined risk, and many of you who have dialed in before will have seen this slide before, but I do like to go over it each time because I think it's a very powerful slide. One criticism has been levelled against structured products and structured investments in general has been complexity. And the underlying constituents can be complex, but actually they are defined return, defined outcomes. And this means that managing client expectations of their performance is actually pretty straightforward. And as simplified as this chart is, I think it tells us a lot about how we can expect these type of investments to perform over their life. So what we've got here, we're looking at 3 scenarios effectively: strong to flat equity markets, medium-term drawdowns, and then medium-term and sustained long-term falls in developed market equity indices. And if we have a kind of strong to flat markets from here, then you're going to get your 7 to 8% or whatever that yield is at the outset. And you're going to get it in a pretty low volatility way because in the auto call structures, you'll see them kick out as the markets go up and meet those positive return barriers. So it's quite a nice low vol way of receiving 7 to 8. If we're in that kind of orange section, equity markets are more volatile. We get either medium-term significant falls like we saw earlier this year, like we saw in 2016, like we saw in the financial crisis. Well, in most of these more defensive structures, you are still going to generate your return, but it's going to take a little bit longer to get it, and it's going to be more volatile. And that's why we suggest putting them within your equity portfolio, because you can ride out that volatility in anticipation of future returns. And then the third scenario is really a scenario where these type of investments don't work. And that's medium to long-term falls that are sustained in equity markets. So falls of more than 35 to 40%. And in that case, these won't generate you a positive return. Your typical auto call won't generate a positive return. And you'll have an equity-like return, but with no dividends or interest over that period. Now, that opportunity cost has actually dropped with interest rates at 0 effectively, and with dividends having been cut as well. But that still would be a source of underperformance. So the orange section would cover most of what we've seen in developed market equity indices. So you could put the financial crisis in there, the drawdown from COVID, tech in the early 2000s, the European debt crisis in 2012, they would all fit nicely into that orange section where if you had been invested for long term in these type of instruments, you still would have generated your positive return, but you would have had periods where it's taken a bit longer and you would have got your return with a bit more volatility. The one exception is Japan of the 90s, and Japan is an example of a developed market equity index that did fall significantly and stayed there for a generation effectively. And in that scenario, these wouldn't generate a positive return. It's not our base case going forward, given how much fiscal and monetary support has been thrown at every crisis really that we've had over the last 10 years. But it is a risk nonetheless. So it's just, but I think that this gives you a good idea of what the expected performance of these types of securities is and will be going forward. So if we can flick to slide 5, we'll look at an example of a current plan that we actually have open at the moment. This is our Credit Agricole FTSE 100 S&P 500 defensive auto call, and this is paying a potential return of 7.5% per annum. So I just want to quickly run through the structure and highlight the sources of risk and return. So this was a 6-year bond, as said at the beginning. Not a bit like a bond. The underlying asset behind the plan is actually a senior unsecured bond which is issued by, in this case, Crédit Agricole, one of the highest rated global banks, a very large French cooperative parent, and sorry, these notifications, and highly rate, one of the highest rated GSIB banks. And we'll come on to talk a little bit about credit risk in a moment. But the underlying asset is a bond, and one client put it quite succinctly: it's a bond with bells and whistles. It doesn't pay a fixed coupon, but it does pay a return based on the performance of those two equity indices. In this case, it's the FTSE 100 and the S&P 500. Now, when you buy any bond, there are some risks that you're exposed to, and there's some returns you get. So the first two risks when you buy any bond, and as I said, this is a senior unsecured bond, so very high up in the capital structure of debt that banks issue. You have credit risk, which we'll come on to, so I won't spend too much time on that now, and you have interest rate risk. Now, at the moment, as I said, six-year rates, six-year gilt yields are just under 0%. Actually, they're slightly negative. So whilst you're not taking much risk there at the moment, there is very little return to be had. So where does that 7.5% per annum come from? Well, a little bit comes from credit risk. So you're taking credit risk to Crédit Agricole, potentially for up to 6 years. But actually, and we'll come on to credit risk in a later slide, that's quite marginal. So the majority of the 7.5% is coming from two sources. The first is that, and pardon me because I haven't actually gone through what the structure is, but I'm assuming most people are familiar with the kick-out plan. It's a 6-year investment, and you have these opportunities to call early depending on the performance of the equity indices in question. So where are the sources of return? Well, the two sources of return are primarily coming from that equity part of the bond. And the first is that you're capping your upside in this investment. So you cannot get more than 7.5%. If the FTSE and the S&P both rally 20% from here, well, your first chance to call is actually after this second anniversary, and you'll get back your capital plus 15%. But you give away any upside above that. Now, in option speak, when we sell something away, we receive a premium. So that's a risk because you could underperform a long-only equity investment, but we feel you're adequately compensated for that. And 7.5% per annum is a pretty good equity risk premium at the moment. Now, actually, you don't get 7.5% just from selling away all that upside over 6 years. There is another source of return, and actually a bigger source of return and a source of risk. And that's this orange section towards the end of the chart, because this is your capital at risk part. And what you're doing here is you're actually selling very long dated protection, and you receive a big premium for that. And there's a number of technical reasons for that, which we won't go over today in the interest of time, but very happy to pick up any questions or any follow-ups after the call. You get paid very well for that. Of your 7.5%, that's making up somewhere close to 4.5% to 5% of that return per annum. So, but it's also your biggest source of risk, because if we did get a Japan in the 90s type situation where the markets fall by 30 to 40% and stay there for 6 years, well, your capital is at risk. So it's important just to understand that, because that is the biggest source of return, but also the biggest source of risk in these investments. And another reason why we suggest that clients use them within their equity allocation, because of that downside equity risk, albeit you have a very large buffer of protection of 35% in this case. Now, the last kind of point I want to make on this slide before we move on is just talk about the market for those long-dated puts. And there's a very famous seller of those long-dated puts, and that's historically been Warren Buffett, who sold lots of these after the financial crisis. And the reason for that was that he felt that they were overpriced. He felt that they were too expensive. So he was happy to sell those and receive that premium. And as I say, there are technical reasons for that. But he didn't believe that over the medium term, equity markets would experience those type of drawdowns. And he used those premiums, being as part of the reinsurance business, it's a similar rationale. He used those premiums to invest for the long term. And that's really the same dynamic that you're playing here. And we think you're very well paid for that currently. So just flicking on to the next slide, please, Bo. So probability is the key thing with structured products, because they are defined outcomes, defined returns, defined risks. And I keep saying those terms, but probability is really important. And actually, if you look at the performance of these type of investments going back to the start of when these indices were published, so 1984 in the case of the FTSE and the S&P, you can see the track record is very good. So we've got two charts here. The first chart on the left-hand side gives you a historical back test, effectively, of how this security would have performed if, theoretically, we'd issued one every day since 1984. And then what we've done here is calculate what percentage of times the security would have called in each year. So you can see here there was no call in year one, but in year two, you had around 78%, just under 78% of occasions, this security would have called and paid you your capital black plus two lots of your coupons. Now the second chart, the second column here, shows you a different measure of risk. This shows you a forward-looking measure of risk. And the way we calculate that is to imply what the probabilities are from what you're getting paid for the underlying options. Now, again, in the interest of time, I'm not going to go into too much of this, but the striking thing you see here is that there's a very different number between what's happened in the past, which is that you've never lost capital, and what's implied by the forward-looking probabilities. And this is really the arbitrage that Warren Buffett and anyone who's selling long-dated protection or long-dated kind of tail risk insurance, which is what you're doing here, is effectively exploiting. Because there's a difference between your market view and where you think equity markets might go and how options markets price them. And that's the arbitrage that you're taking advantage of here fundamentally. And this is exactly the arbitrage that Warren Buffett's taking advantage of when he's selling long-dated puts. So if we could flick on to the next slide, please, Bo. So the current plan we've got out is an auto call linked to the FTSE and the S&P. And we do tend to come out with quite a lot of dual index auto calls. And what we found is actually that advisors historically have tended to avoid or prefer single index. And dual index does introduce an additional risk because you need both of those indices to be above your barriers, or in the case of losing capital, one of them to be below. So it is an additional correlation risk. But we believe you're getting paid very well for that at the moment. So we'll look at an example of a single index versus a dual index. But what we've got showing on this slide here is plotting those historical probabilities. So going back to 1984, of a single index, which is the dark blue chart. Lighter blue is the FTSE S&P auto call. And the FTSE Euro stocks is the even lighter blue there. And looking at what those paths look like historically. And the first observation you make is that they actually look very similar. The paths of whether you've been in a single, a dual FTSE S&P or FTSE Euro stocks is very similar. Calls are skewed to the early years, but there's very little capital erosion or capital return. There's a slight uptick in loss when you look at, or non-positive return when you look at the Euro stocks, and that was primarily driven by the financial crisis just over 10 years ago, where the Euro stocks was a smaller index and is a smaller index. It's a more volatile index, but it was also heavily weighted towards banks at the time, which were obviously at the eye of the storm in our previous crisis. So the paths of those autocalls, whether you're in single or dual, look very similar, but you do get a decent pickup in pricing. And if we have a look at the next slide, we can just put those side by side. So on the left-hand side, we have the current plan that we're out with, which is the FTSE S&P, and on the right-hand side, an equivalent FTSE. And the key difference between them is that you get paid 6% on a FTSE-only defensive autocall today, whereas it's about 7.5% for our current plan. And that 1.5% to 2% area is typical of the sort of premium that you get for moving from a single index to a dual index. Now, as you can see there, again, we haven't plotted the bar chart, but we've just put the probabilities. And historically, they've worked in exactly the same way. The probabilities are very, very similar. The chance of capital loss is, the probability of not having got a positive return is still very, very low. And the chance of capital loss historically has been 0. And actually, if you look at the forward-looking probabilities, they're quite similar as well. So they are slightly higher for the dual index, but again, that comes back to that arbitrage because you're taking a small amount more risk for more premium. And it comes back to that risk reward. For that small uptick in risk, and remember, that's the arbitrage you're looking to take advantage of, we feel 1.5% per annum is a good pickup. And one of the things probably just worth pointing out here is your biggest risk in these, aside from credit risk, which we're going to come on to on the next slide, is that Japan of the 90s scenario that we saw in the earlier slide, that red section of your free outcomes. Now, in that scenario, the FTSE has been the underperforming index over recent years, and it's not just lagged the recovery versus the tech-heavy S&P in following March, the March lows. It's lagged the Euro stocks as well, and it's really been a laggard for a few years since 2016, and it's likely not to outperform significantly given its relatively high weighting of high dividend kind of value type companies. But when we're in that scenario, if we come back to that red section, it really doesn't matter if you're in a single index or a dual index, because at that point of very heavy sustained falls, like we saw back in March, correlation across all assets actually, but especially within developed market equity indices, is likely to be very, very high. In fact, it's likely to be 1. So in that scenario, your biggest risk scenario, it really is going to be much less important or much less likely a factor whether you've been in a single or a dual index. The key thing about being in a dual index over the medium term is you would have been picking up that extra yield cumulatively, and 1.5% compounded over a period of time actually adds up quite a lot. 1.5%, 2% per annum compounded over a long period of time as you reinvest is a decent amount of premium for not a huge additional risk. So that's really the fundamental reason why we like we like dual index. We think you currently are being paid well for it, and you're not taking a huge amount of additional risk for that additional premium that you receive. Moving on then to credit risk. And I said we would come back to credit risk. And it's really the first thing that needs to be looked at when you're considering these type of investment plans for a client's portfolio, because ultimately it doesn't matter what happens to equity markets, the issuer of the security must be solvent over the life period to honour that commitment to pay back the whatever the defined return is. So credit risk is really important. If you don't like the credit risk that you're taking, sort of do not pass go. Don't be enticed by high rates for lower rated credits. We think that that's a really important place to start. Now at Dura, we work with only GSIB issuers. These are globally systemically important banks. And these are the big global financial institutions, the likes of Credit Agricole, Citigroup, Credit Suisse, Societe Generale, those type of names. And the reason we like GSIB issuers is that they have to hold additional levels of capital. Now, remember, you're a bondholder, so the more capital and the better quality capital that you have, the better, because that's what's there to protect bondholders. Now, what this slide is showing is credit spreads going back to June 2008. So really looking at what credit risk looked like over the financial crisis, because that was a bank-driven crisis. It was a liquidity crisis, and we saw that credit risk increase exponentially across banks. And the orange square is where that credit risk is at the moment for a number of global banks. And almost without exception, you can see that we're towards the bottom of the ranges. They're a little bit higher than they have been historically, just because of the volatility we've had this year. But they are still very much at the bottom of these ranges. So, you know, banks, big global banks, are not the source of this crisis. And actually, every bit of regulation that has really come out over the past since the GFC has been around repairing those balance sheets, and the regulation has been about balance sheet strengthening to limit and mitigate the systemic risk that these banks could and did pose, 12 years ago. So if you look at them from a fundamental point of view, and that's what we do at Dura, is to look at how comfortable we are with these credits. We look at them on a number of metrics, including capital ratios, so how much equity do they hold on their balance sheet, which is what's there to protect the bondholders who are higher up the capital structure. And, there's more of it and there's lots of equity. Funding, how do they access funding? Well, structured products is one way of accessing medium-term funding, but how much of their funding comes from wholesale markets, which tend to suffer when there are periods of illiquidity. And actually, we had that back in September last year, where the Fed stepped in to improve the repay markets, but really wasn't a news story outside of kind of financial markets, because it didn't pose any systemic risk to these banks because they have diversified their sources of funding. And the last thing we tend to look at is asset quality. How robust are the assets on the balance sheet? How susceptible are they to losses? And that is a question now that we're spending a lot of time on. We feel very comfortable that banks are in a good position and have enough capital to absorb the losses, which undoubtedly will and are materializing from this crisis. But we feel very comfortable with that. And you can see that's reflected by what the market thinks as well. If you look at those credit risk levels, as I said on that chart, a low number is a stronger credit. I want to wrap up there and open it up for some questions, which hopefully there is. I just want to give you a quick summary. So, we've raced through that in 20 minutes. I can usually speak for 2 hours on those slides, but Bo told me I couldn't have 2 hours today, much to your pleasure. And so, what are we looking at? These are defined returns, defined risks. We're in a low forever interest rate environment. We're looking at alternative sources of equity income, or equity risk premium in these cases, is an attractive proposition. Adding to the low interest rate environment, we've got dividend cuts. Now, they could be short term, but there is considerable uncertainty on how quickly those dividends could grow in the near term over the next 2 to 3 years. So this is a way of getting a decent yield from equity markets. They have a great historical track record of generating those equity-like returns, as we saw from those historical probabilities. And that's the key thing there. They have a very high probability of generating an equity-like return, but they also have a good buffer of protection to the downside. At the moment, certainly looking at some of the index levels, there are attractive entry levels. Not as attractive as they were in March, clearly. We've rallied strongly from the lows. FTSE has been somewhat of an underperformer, but getting in at 6,000 versus getting in at 7,500 plus not that long ago seems like an attractive entry level. And the last point really is that bank balance sheets are in really good shape. And we're comfortable with credit risk at the moment. You're not getting paid a lot for credit risk at the moment, but there's a reason for that, because we don't feel that's posing a significant risk. And with that, I'd like to hand over if there's any questions.
Yeah, Nick, we just got a couple to cover off with you. One, maybe just further thoughts, or I know that you've just talked a lot about credit risk and banks, but especially over the past week, this idea of a second wave of the virus of COVID-19. Any challenges to those banks that you see coming in the second half of the year? Any concerns?
Well, yeah, their share price. I'd rather be a bond holder than an equity holder at the moment, I think, for most banks. I mean, we're going into Q2 earnings season now in the US, and I think that will shed quite a lot of light on how resilient banks are. In fact, JP Morgan just released their results today for Q2, and the key thing people are going to be looking for. So we're coming, in that capital funding asset quality equation, we're really looking at the A, asset quality. How much has that been impacted by the COVID so far, but also whether a second wave comes and what impact that has on the real economy, because that will hurt balance sheets at banks, and there will be loan loss provisions and there will be loan write-downs, undoubtedly. JP Morgan had their results today. It's a US bank. It's had a great quarter from trading on the levels of volatility. But I think we can, as we see more banks come, we can read across the results. Now, they posted an additional 10.5 billion loan loss charges in Q2. And that was in addition to 8 billion, just over 8 billion in Q1, which is a huge amount. Don't get me wrong. But it's manageable with their balance sheet. And in fact, I've written down Jamie Dimon's comment earlier because I didn't want to misquote the great man, but he said, his quote was, "We ended the quarter with massive loss absorbing capacity." And what he means by that is they still have very significant levels of equity that will be eroded before bondholders could be touched. So that capital, that equity capital, is there to protect bondholders. So I would rather be in the upper parts of the capital structure in terms of bank liabilities and down equity. I think it's going to be a tough environment for banks with very low net interest margins and loan losses coming through over the next potentially couple of years. But I think as a senior bondholder, as you can see, that's as reflected by where those credit spreads are trading. Those are 5-year credit spreads, by the way. Can't remember if I said that at the time. The market is not pricing an awful amount of risk into that currently. If you throw in the fact that over this period, earnings should grow from a very low level, and you've got reduced dividend growth, whether it's dividend complete cuts as we've seen across Europe or caps on dividends in the US. And in the US more so than for UK and European banks, it's about reducing those buybacks. All those things are good for bondholders. Dividend cuts, cutting your buyback expense, and growing earnings are very good for bondholders. I think it's going to be a challenge actually for equity holders, but we've seen bank share prices haven't done particularly well since the financial crisis because of this growing level of capital and the deleveraging of their balance sheet over that period versus where they were 10 years ago. So I feel pretty comfortable with credit risk at the moment. The only thing I would say is that you're not getting paid a lot for it currently. A 6-year credit agricole bond in sterling, you'd probably get somewhere around 0.5% to 75 basis points per annum. So you're not getting paid a lot for that risk at the moment, but that's a reflection of the perceived low levels of risk in it.
So quite a change of tack. First part of the question, pretty easy to answer, but maybe expanding on the second part would be a good one. Is what's the minimum and the maximum investment amounts for our plans?
Sure. So the minimum investment is £3,000. The maximum investment, I believe, on our terms and conditions is £500,000, but don't quote me on that. The only thing I would say on the maximum is that if you have, and I think that this is something that we have ongoing dialogue with advisors around the book building period, because we hedge an amount on day one, and when that's filled, in some cases we're unable to increase that hedge. So letting us know for bigger tickets is always helpful, because it means that we can protect you a little bit in case the plan is oversubscribed. And we did, we had seen that over March and April, where there was very attractive terms on offer and even more attractive entry levels. So that's something where at the higher end, if you could continue to have a dialogue with us to ensure that we can protect that for you. But also, we are seeing more and more larger tickets, larger single tickets from clients as advisors are using these for some of their higher net worth clients. So I think, if you can just keep us in touch on the bigger tickets, but there really isn't a cap. I mean, as part of our business here, our asset management arm, we run a fund of a similar type of securities, and we've got just over 1.2 billion of assets under management there. So, the market's big, because the market in senior financial bonds is very big, and the market in those liquid developed market equities is equally big. So caps is generally not an issue for us, assuming the pricing environment hasn't changed too much over the book building period.
Great, Nick. Nick, I'm conscious of time. We have had a few more questions around why we're using major market indices. Also, some of actually referencing what you were just mentioning about our other sides of our business, our institutional business, and trends you're seeing there. Any closing points maybe you'd like to make, taking into account those couple of factors?
Yeah, sure. So as I mentioned, there we've got an asset management arm. We also have an institutional securities business, which has been going for almost 12 years now. We've originated over 10 billion in that business. These are UK asset managers and discretionary fund managers who are buying exactly the type of instruments in security form. They're buying the same things that we're issuing Dura, and really the idea of launching Dura was to give more access for retail investors via their advisors to access this asset class. So it's a deep and liquid market, and that's something we want to continue to grow. And sorry, Bo, I forget the first question.
It was just we've kind of our use of major market equity indices. So things like some of the guys on the line now might have previously seen, say, a basket of stocks or even single stock structured products before.
Yeah. So it comes back to risk reward. I mean, if we're looking to target that sort of 6 to 10% area, you really don't need to move away from developed market equity indices. We don't need emerging market indices. We don't need single stocks. If you're looking at single stocks, you're looking at much higher risk, because stocks can and do go to zero, probably more regularly than we remember. But also then you're looking at higher return. If we had a dual stock basket, and it depends on what the stocks are, but you might be looking at returns of 12 to 15% plus, which is not a risk profile that we're necessarily thinking is necessarily relevant or appropriate for the type of pension portfolios that these are typically being used within.
Okay, sure, Nick. That we're a little bit over, so I think I'll just wrap up just to kind of reiterate that we are available on a number of platforms and SIP providers with our current offering, and we have strong relationships. If you do have any queries about accessing any of our products, either directly or through platforms, please do get in contact with either a member of the distribution team, who I think you would have had contact with previously, or as you'll see, there's a few contact details there that you can kind of ping any further questions through to, or give us a call. Nick, thank you very much for your time today, and for all those who've dialed in, thank you very much, and have a good afternoon.